Holy F. Are stocks about to crash? Because the exact same warning signs we had the last three times could be here by the end of the month. Today, I'm going to give an update to a video from 8 months ago because right now, the $14 trillion rally is looking for a playbook. And I think I have one for you today. So that's right, cool man. What are we going to do? We're going to talk about insurance because you buy insurance exactly when you don't need it. This is really what I think is going to happen here. Pause if you need to. We're looking at something called the SEP. We get one on September 17th and one more on December 10th. This is when we get something called the dot plot. The dot plot basically tells us what the Fed is planning to do. Here's a simpler chart that you might find easier to digest. Here's what happened when we did a first cut roughly a year ago. And what happened? The asterisk is going to be the SEP. So we went higher for a little bit, right? Higher high, higher high. But on the second one here, oh my goodness, that was the biggest drop in 50 years. Is this going to be the second biggest drop in 50 years? Because I see the exact same thing setting up. The 50 DMA is really strong support, the ratcheting higher. And honestly, a drop like that would not even be bearish. It would set the stage for consolidation going sideways and then potentially rolling over. That's really the story for today. So if right now there's a 100% chance for a cut in September, a 90% chance in October, an 84% chance in December, we're going to see that right here. We're going to see it in this number. I know what it means. If you don't, please stay tuned because I'm going to walk you through my playbook. I have lots of really important notes. The more important thing here is that this is a leading indicator. So what I showed you in the earlier slide here was that going back to 2024, like the initial meeting was not actually the big move lower. It happened a few months after. So if we have more than one piece of evidence, it tells us that we're like really shaky here. We bounced back up to like 55, 56. Let me double check. But it's been failing between that neutral and fear. So what's really important here, as I can see right now, we're back here in a neutral. So this is called a bounce. If we look at where we were a week ago, I would argue that that's a lower high. So right here we have 56. Now we got 55. We got 54. Well, that's a lower high. One more lower low, and we could be setting up for the drop right here. It could be delayed. It could not happen, but I'm definitely buying my insurance. So roughly 8 months ago, there's a few charts that I talked about. And I'll give you an update on those in 1 or 2 minutes. But the first thing I want to do is actually just tell you exactly what I'm doing in my personal portfolio, because I think people just really care about, okay, words are nice, but what are the actions? I'm already 100% cash in one account. In the second one here, I'm going to be selling another 10% of my holdings, going to over 80% cash. That is really high for me. Cash is my biggest position right now by far. Like I mentioned, my other accounts already mostly cash, and I am looking to go net short. What's the reason why? It's because of this right here. Look at that number, 119 risk reward. What the F? 119 risk reward? Yeah. And it's due right now within 0 candles. So I am not messing around. The significance of 646 that I alluded to before basically means that if we decline into the end of the month, we're going to get a fail breakout. So look here. That's a failed breakout, leads to a bearish engulfing candle. That's a failed breakout, leads to a bearish engulfing candle. That's a failed breakout. We didn't get a bearish engulfing candle, but we had 2 or 3 fails in a row. Okay, now, if we go here to our weekly chart, this week we did manage to go higher. So the notes are not going to say that I'm bearish right now, I'm making a prediction, which I don't normally like to do. The last 3 weeks here on the weekly, fail, fail, fail. Now we're back above. If we fall back below here again, 646, that is what's really significant to me. I have it noted on my chart right here. That's how important it is. It's a big pivot. We fall below that. Oh boy, it gets hard to get pretty bad pretty fast. All right, so a little bit of a clickbaity video today, but I really want you to hear the warning. So if you're still watching, first of all, thank you. Second of all, we have to ask ourselves like, whoa, 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 what about the economic data? Well, that's exactly what we're going to talk about here at President Trump. So if you can cool your jets for 1 second, maybe we're going to have a little bit of a problem. What's that little bit of a problem? Well, if we look a little bit closer to the economic data, there's a little bit of a problem. So last time, please take the warning right now. When do you buy insurance? When you don't need it. If you feel like you don't need insurance right now, it should be cheap. The VIX is low, and there's a $14 trillion rally looking for a playbook. I just basically gave it to you. Sideways is the new up, and down might happen soon, might not happen at all, but having that insurance will be very nice. So right here, we're setting up it perfectly because it was September, skip, December. So now we've got September, skip. Is now the time we're going to pull forward? Well, it kind of seems like it. And before we go further, I'm going to ask you for a huge, huge favor. If you could please consider smashing that thumbs up or subscribing to the channel, I would greatly, greatly appreciate that. Thank you ahead of time. So this is where we were at the end of June and looking back to March. This is what matters right here. It's really the Fed funds rate and these numbers. Does it matter what they are? No. What matters is that people are expecting them to get cut. So let's read the note that I have right here, AKA buy the hype, sell the news. That's my 2 cents. In December, we get 1 times dovish cut. So sorry, that should say in September, which means next week, next Wednesday. In September, we get 1 times dovish cut. Because we're going to be getting more cuts into December. That's what I expect. They have to tell us where do they expect the Fed funds to be by the end of this year, end of next year. End of this year pretty much implies if we're going to get 3 cuts. There's an 84% chance of that right now. In December, we're going to get another SEP or another one of these. And that is when we find out whether we get more cuts into September and then more cuts into 2026, which means that the next SEP, which again is right here. This is really important. Please pay attention. On December 10th, we have that happening. We even have more economic data, but I really want to focus on Jerome right now because this is really important. If we're going to keep getting dovish cuts into 2026, hey, and we're going to rally to infinity and beyond. Fantastic. However, I think the law of diminishing returns may be kicking in here. Let me make it really simple for you. After we have one of these failed breakouts, if it happens, again, end of the month, below 646, where do we usually slam down to? Let's snap our tools here. Fail breakout, hit the 50 MA. Oops, I can't draw it all today. There we go, hit the 50 MA. Fail breakout, hit the 50 MA. Fail breakout, oh my goodness, fairly close to the 50 MA. If we hit it again here, what are the odds? Well, they're not 0. Look a little bit closer. Oh, no. Don't look closer. That's scary. Yes, that is very scary. Okay, if we look further a little bit more here, right now, we actually have pretty strong growth. So people are pretty worried, but do we really have stagflation? That's what the market is worried about. In the short run, whether an economy is in recession or to the upswing can affect trade imbalances. A recession tends to make a trade deficit smaller or trade surplus larger. Oh, okay. Looking back here to roughly 50 years ago, again, for the headline of today's video, this is a secularly rising interest rate environment where we have higher lows and higher highs. I think that's where we're going right now because we do have the first higher high. Just not sure where that higher low is going to get formed. If we look back in time here, again, going back roughly a year ago, where I laid out my playbook and I said, the market is hyper-focused on the first 25 basis point versus 50. I think the same thing's happening now. Oh my God, a big 50? I don't think that really matters. I think that's the wrong way to think about it. I'm more focused on the news versus the reaction to the news now because a big pause generally means a big recession. We just had a big old pause, longer than before. Yes, and the Fed actually gives us what they call sufficiently restrictive. So if they are really data dependent, we're going to find out right now. So again, if you could please consider smashing that thumbs up, subscribe to the channel. Thank you again. Last time I'll ask. So if we think about then versus now, let's think about this. If the Fed funds was at 5.3, now we're exactly 100 basis points lower or at 4.3. Well, here was the data. Okay, there we were a year ago. There's where we are now. Well, I think we are higher. So we're roughly 2.6, 2.7. Now we're at 2.9. So according to the Fed's own formula, here's where we should be. Because right now we're at 4.3 for the Fed funds effective rate, or FRED. All right. Is that a problem? Well, this right here seems a lot like 1995. One little dip down, start to get a little bit sideways. Are we going to go up? Are we going to go down? Well, this is the Fed's formula. Sufficiently restrictive means core plus 1.6. Well, 4.3 is the Fed funds, which I just showed you. 2.9 is the core PCE, which I just showed you. It's right here, 2.9. Actual, 2.9. Cool, it came in line, but it's rising. The previous was 2.8. That's a higher high. Higher high, double top, higher high. That's a trend. What is it? It's rising inflation. So 4.5 is equal to 2.9 plus 1.6. If you're not a math whiz, just basically tells you that we should not be cutting. Powell's not going to want to cut. I think there's a good chance he could actually come out and say that, right? We're data dependent, blah, blah, blah. Pause this if you need to, too. It's me highlighting what I think was relevant a year ago. I think it's still relevant now. Where could the bulls have gone wrong? Well, right now, the AI theme has been juicy. Is it tired now? It's been a year. Economy shows weakness into Q4, Q1. Well, I just showed you Q3 GDP print at 3%. So just like a prescription, like we said here, is the Fed going to give it the right dosage, or is it going to be reactive to feedback? Well, I don't know. Why? Well, remember, being early is like being wrong. The Fed is now a year later cut by exactly 100 basis points. And my prediction was correct. So what do we do now? September and December dot plots are really key. Remember, fundamentals say what should be happening. Technicals say what is happening. This is what's supposed to happen after a big pause, right? Big pause, that's 6 months. That's a recession. Great parts of recessions. Big pause, big recession. That's the Great Recession. Pause, that's the lockdown recession. Oh my goodness, the pause was just as long as 2008, but we're pausing for even longer, just like we did in 1995 to 99. The Great Recession, the C word. Hey, if it's 1997, 1998, or early 1999, let's party, right? Because Kool-Aid is here and he's breaking through the wall. So, that's what we want our accounts to do, right? All it's going to cost us is the future. Okay, cool. Let's ask ChatGPT. What did Powell say at the last Fed meeting to make stocks go down? Ask yourself whether or not there is a realistic chance this could happen again right now. Interest rate cut was modest and expected, but future cuts were scaled back. They could cut in December and announce in December. That's what might happen. There might be dissents. If you're not sure what that means, pause, drop a comment, or anything else. I'll try my best to help everyone I can. Powell said inflation is still too high, and economic strength gives Fed leeway to proceed cautiously. I just showed you exactly the same thing. Uncertainty about limits on forward guidance. Right? Why stocks dropped? Investors had already priced in more aggressive cuts in 2025. Well, there you go. When the Fed signaled fewer cuts, then that lowered expectations and future profits, especially for growth stocks. There you go. Also, in case you forgot, in 2018, we had the exact same president and the exact same Fed chair. So long way from neutral. My stocks went down pretty fast. So I'm not saying Jerome Powell is going to make stocks go down. I'm just saying that the recipe is awfully familiar. And when I look at this headline here, like it's an awfully big coincidence that a lot of swans fly in September. I'm talking like a lot of them. 1609, okay, that's a pretty long time ago. Okay. 1818, 1683, 1776, 77, 1814, 57, 89, 90. Hurricanes happen in September. It's like there's a lot of bad stuff that happens in September. It's a spicy month. It is. Here's some pretty spicy headlines, too. The FTC is going after Amazon and Google in probing their searches. Russian war games feed NATO anxiety after Poland drones incursion. Record high beef prices remind shoppers of costly egg shortages. This could be the next wave of inflation. And then there's meetings happening later this week. Starting tomorrow or today, depending on when I publish this video on September 14th. There's going to be meetings between the two big countries. But into that, they're now actually investigating the U.S. Ooh, big bad U.S. That's right. So holy F. I said the first time in 50 years, and I told you after the fact. Today, making a bit of a prediction. So maybe I look a little bit silly, but honestly, I don't care what people think on YouTube anymore. Oh, well, you said you were going to be bearish on one day tomorrow. Yeah, okay. Well, did you understand the meat and bones of the potato? Sorry, not the of the potato, of the video. Was I right 1 or 2 days out? If you understand what I'm laying out here, there's a reason why I'm getting bearish. I'm getting increasingly more evidence. Betting against the Dow Jones, the Russell, semiconductors, the S&P, which is going to show up next week. We have a magic number, 646.47. We were below it partly this week, I believe. Let me double check. Yeah, 647. We were at risk of going below. I'm like, oh my goodness, if we fall below that, we're already in a failed breakout. I'm getting a little bit anxious, but my anxiety doesn't mean that I'm right. I've been anxious for a few months, and I have a feeling I'm going to be right this time. So what am I doing? I'm gonna wait for evidence. We are back to 4 out of 4 bullish on the weekly. Have been getting warnings for a very long time. May not believe it when it finally happens. So here's what I want you to do. It's technically impossible for us to go down. Let me read the note here. Why? Because my notes were prepared. Technically impossible for us to go down to support or the 50 MA, which is at 610, unless we actually get the bearish recipe. So if you're still watching, just watch for this, because it's what I'll be watching for. On a weekly chart, which happens no earlier than Friday at 4 o'clock, we have to do this. We have to print the lower low. Then we have to close below it. I think that's pretty much going to be the coincidence for my SHL go, what I'm looking for to go short. So if you understand what that means, great. If you don't, again, pause the video, read, or drop a comment if you need to. Show up on Monday at 8:30 if you want to see me live. We are in fully bully boomtown. We got 613 as our key area. It's a lot higher than now. Our gateway for the bears is 565. What I want to remind you of is that the video I just showed you was, again, the biggest drop in 50 years. So it might happen all at once. And true to form, Powell was at risk of making a headline on the 17th. So here we go. We got tons of news this week. We got an election. We got a meeting. The meeting's going to be done. Then Jerome Powell speaks. We got the Bank of Canada. We got the FOMC and SEP we just talked about. We got Trump in the UK on the same day. Then we got the TikTok ban on the same day. And then we got the BOE, which is England, and BOJ, which is Japan, on Thursday. All right. We got through that one there. Another fun one here, stagflation. So this is where there is more evidence that does not happen in 1 month or 1 quarter. It usually takes quarters or a year, maybe more. So stagflation is just exactly what I mentioned in the last video as well. As the West edges closer to stagflation, economists are blaming Trump because since he took over, well, inflation's going up. So we have high inflation, high growth. So growth is currently at 3.0 and core CPI is at 2.9. So we have nominal growth or real growth of 0.1. What is that? That's called stagflation. Pause this one more time here. An economic cycle characterized by slow growth, a high unemployment rate, and high inflation. Well, again, I'm not the one making the data. This looks like higher highs to me, right? Lower highs, higher highs. That's a recovery. That looks like a recovery. Food and energy. Well, it looks like a recovery. Again, not my department. I'm just the one showing the charts. PPI is going down, so it shows that we should not be getting more, but the data is getting all mixed up here. So staircase up, elevator down. And if more people are starting to do what I'm doing, then they have to ask themselves, like, where is the law of diminishing returns going to kick in here? That's really the important question for me. So already a really long video. I was aiming for it to be shorter. I'm going to go through more of this during the week. The Russell, everyone thinks it's going to go up now for the next 12 months. The risk-based stocks are going to go up. This looks like a pot and handle to me. Another retest at the all-time high. If it manages to go higher, excellent. Broadening out. If it doesn't, watch for the fail break, because that's what I see setting up here. Everyone already appears all bulled up for the next 12 months. So now it has to deliver, get that all-time high. And then QQQ. Oof. All right, look at that chart. Man, that looks tired. Oof. That looks extended to me. Excuse me. So I think the chart's going to come back down to support. So if there's a 70-point decline for support, we can overshoot after we hit support too, right? It can come down, it can pause, it can go lower, it can go higher. This is called mean reversion. Usually likes to come back down to home base, which is the blue line. Goes too far, comes back down. Goes too far, comes back down. As I showed you at the outset on the S&P, well, that's a lot lower. It's almost 100 points now. We have to be mindful of it. That's a bear market if we go down there. It's 20% decline. So look a little bit closer at the data, because spaghetti-o, you might wake up and not have a chance to sell at the prices you like. Might get the prices you want. Well, button up here, because that's what I think we have to do. All right. So like I mentioned on the S&P, technically it's impossible for us to go down to support unless this happens first. So if on Friday you say that, okay, well, Justin was wrong again. Well, I gave you warning to buy insurance. I'm not telling you to go net short like I'm planning to do now. I'm saying that if the evidence is there and the trade is so good you can't say no, then say yes. Otherwise, be mindful of the risk and be mindful of the evidence or the bear recipe, which means that choose your dominant time frame, daily, weekly, monthly. And if this happens, I would highly encourage you to not ignore it. Get to number 4. Might be time to get knocked out. All right. If that interests you, come hang out with me on Monday at 8:30 a.m. Otherwise, thank you very much for tuning in. I'll see you on the next one.